Good afternoon, good evening, good morning, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. Today, we're going to be looking at another important topic that we have been, that a lot of us are going to enjoy. All right, so just as usual, we need to look quickly, just do a quick housekeeping. So wherever you are joining me, I want you to type on the chat box your name and you are joining from. If you are joining, for example, from Canada, just your name and Canada. And if from United States, United Kingdom, anywhere you are joining from, please, I want you to please type your name and you know tell us where you are joining from. Again, this is going to be an interactive session, right? So I'll be asking questions. If you have any question, you can just drop your question on the chat box, all right, so that we can look into it after the meeting. Again, I also want you to share this to friends, families, especially today's topic is going to be special and it's going to be focused on medical professionals and business owners. So if you have medical professionals as friends, as family members, as colleagues, I want you to please share this with them so that they can also benefit from uh, the presentation. Once again, my name is Oludare Fasola. I'm going to be your host and presenter tonight. Uh, Again, I want you to please, as you are joining, please type where you are joining from and your name. So I'll quickly go ahead and just pull up my slide and go ahead and share the presentation. So tonight we're going to be looking at why retirement planning matter more for medical professionals and business owners, while retirement planning matter more for medical professionals and business owners. And you agree with me that one of the important things that really affects you as a medical professionals and business owner is your retirement. All right. You have a unique way, and because of the nature of your business and your job, right? Many medical professionals don't have pension. So, and as such, they have to plan for their own retirement. But what I've noticed in the past is that a lot of them delay retirement planning due to some certain reasons. And of course, it is not their fault, it's just because of the lack of financial education. So I'm going to be diving into why it is very important for you as a medical professionals and business owners to plan for your retirement early in especially in your career. Right. So let's quickly go into the next slide, which is important disclaimer and housekeeping, right? Uh, Please bear in mind that this presentation provides general information, not a specific advice, all right? And the content does not replace the professional guidance. So you need to consult your financial advisor for personalized planning for qualified professionals. So please, if you want more information, reach out to your financial planner, financial advisors for more information. Okay. Now, let us look at the objective. What is the objective of this presentation? Number one, I want to emphasize the importance of starting retirement planning early, right? So, retirement planning is important aspect of our business, right? And we as an advisor, we need to, right, educate professionals on the need for them to plan early for their retirement. Now, we're going to also look at demonstrate how to use strategic retirement tools to preserve and grow wealth. Now, there are so many strategic tools that uh, we use for retirement planning. So we're going to be looking at what are the different tools that we have and how can we leverage on these tools to plan for retirement, especially for you as a medical professional and business owner. And of course, we want to explain the tax advantage available to high income earners and provide actionable strategies tailored to self-employed and high responsibility roles. So what is retirement planning? This is the questions I've been asking many professionals, but I'm kind of, you know, they have not been able to provide a solid answer, or provide a very, at least important informations as regard retirement planning. So let's look at what is retirement planning. Income replacement planning, not just savings. Let me be very, very clear about this, right? If you are looking at retirement planning, it is not just about you have an income when you retire, right? It's not just about savings, right? Now, retirement planning project future needs based on current lifestyle. Now, as a medical professionals, as a business owners, you want to make sure you do a thorough financial analysis to understand your current lifestyles and project for how much are you going to be looking at when you retire. And these are the mistakes that people make. People believe that once I have pension, once I work for maybe normal years in Canada, 20 years, 30 years, and I have pension, and of course I have registered retirement savings plan, at least I'm good for retirement. That is not retirement planning. Retirement planning go beyond. You have um pension and register retirement plans, or probably you have other savings, tools in place, like other vehicles, like maybe TFSA and other strategic tools for retirement planning. It go beyond that, right? You need to look at the futures. What is the current life size? What is uh my traveling, for example? What kind of travel do I actually embark on every year? The kind of life, the kind of house that I live, the kind of clothes that I wear. Of course, it's a general overview of current lifestyles, and you want to project that how much will I need when I retired and when I'm no more working? How much do I really need in order for me to retire well? It is very, very important to understand that. And many people don't really understand it. They only plan towards retirement. They don't evaluate their current lifestyles to project for the future, right? Again, income planning, create reliable income streams for life after work. I've seen this in many, many cases where people plan for their retirement. After like maybe few years of their retirement, they run out of money, and they feel like, oh, what all the money that I've put aside for my retirement is not even sufficient enough for me to retire. It's not their fault. It's lack of financial education, or probably they did not work with an experienced advisors that will help them to look at their current lifestyles and project for the future of how much do you really need when you retired. I was speaking to somebody today, and the person was telling me that, look, I work in a retirement home, and I do ask questions that how much on monthly basis do you pay for where you are living here? Some say $5,000, some say $4,000, and it's premium. Like, they have to pay for that because why? They've already planned for that. How many people do understand that when I retired and I go to retirement home and I want a good retirement, I need to plan for that? If you go to a retirement home, some be like, oh my God. If you go to another home, it's just like a Buckingham Palace. So you need to plan for your retirement. It's very, very key. And nobody will do that for you. You have to be intentional about your retirement. You need to plan. You need to understand that it is my duty to plan for my retirement. Nobody's going to do it for you. The government will not do it for you. Even if you are not a medical professional, you are not a business owner, and you are still a salary earner, it is your responsibility to plan for your retirement. If you go to Canada CA today and check how much is the average pension if you retire at age 65 in Canada, it's probably about $899. What will that do for you when you retire in this country? So it is very important that you plan towards your retirement if you don't want to live a life of regret. Now, let's go further. Why this matter more to high income earners? Like, medical professional is one of the highest professional that get highest get paid in Canada, they they I mean they make a lot of money. But it is not how much you make, it is how much you can actually save and compound tax free. Because it is not sufficient enough to say, okay, I'm making $1 million in a year, I'm making $500,000 in a year. Of course, so medical professionals make more than that, right? But the question is, how much do you really save? Now, let's look at it. High standard of living to maintain. There are a lot of factors come into this, right? Because of the lifestyle inflation, because we make so much money, chances is that you have to, like, the kind of lifestyle you live with is so big. And if you are doing that, did you actually plan towards your retirement? Did you foresee that, oh, in 20 years, 30 years after, working so hard, save life, right, treat people, what will my retirement look like? Did you really even look at yourself, look at your standard of living? Number two, tax burden. High taxes reduce available retirement income. Now, if you are not careful, all the money you think you save towards your retirement, by the time you start spending it, right, you see how tax will be just, taking this money away. So you need to plan to know how much do I really, need to save for my retirement. Of course, save from taxes. 3, no guarantee pensions. Unlike government workers, must self-fund. You have to fund your retirement yourself. Okay, it is your duty. You must make sure that you fund your retirement. Nobody's going to do that for you, right? Like I said, as you are coming in, please, I want you to type your name on the chat box and where you are calling, when you are joining from. Again, share this with friends, family members, especially medical professionals and business owners who are looking to retirement planning, because this is an important topic for everyone, not only medical professionals, but because this is actually designed for medical professionals, right? If you have them as friends, as colleagues, please try as much as possible to share this. Now, let's look at retirement planning landscapes in Canada. Everybody say retirement planning. Please type in the chat box, retirement planning. Now, let's look at the retirement planning landscape in Canada. Now, as of 2024, the Canada Protection Plan and old age security maximum is roughly about $20,000. Oh my goodness. And this is what some people are actually relying upon. Okay, they are looking at, okay, once I retired, at least my pension and my old age security is going to give me sufficient money when I retired. I'm telling you, you are deceiving yourself. Okay, 50% typically have shortfall for professionals. So there is a income gap of about 50% for medical professionals and business owners, right? Don't forget that they have to plan for their retirement. It is not the duty of the government to plan for their retirement for them, right? And again, roughly $100,000, typically they need it for annually when they retired. And if you ask me, how many medical professionals really understand that at least every year I need roughly 100K more to retire well wherever I find myself? It is very important that we understand this. Now, this is retirement planning landscape in Canada. Now, let's look at the MD Financial Retirement Gap Finance. The MD Financial is a body responsible for, looking into the needs of medical professionals in Canada in terms of insurance, retirement planning, estate planning, any form of finances. This is the body that actually look into this, right? According to the research, 60% of physicians underestimate needed for savings. Now, what I've seen mostly in the medical professional is that they underestimate retirement, probably because they are earning so much money. They will tell you, no worry, I'm going to do that at so age. I'm going to do that maybe next year, and next year become never, right? So they look at it from the point of, oh, I'm making so much money and I can start that at any time. It is not like that, right? If you don't start your retirement early, it will cost you more in future. So think about it, right? You are supposed, the moment you start working, okay, when you start your medical practice, your top priority should be, how will my retirement look like? So you must put an actionable, intentional strategies in place to make sure that you start planning as soon as possible. Okay. Number two, income expectations. 78% of medical professionals seek 100K plus yearly income. Now, most times, every year, right, medical professionals and business owners need roughly more than $100,000. Imagine that, right? So, if you don't plan very well, how will you be able to save 100K or more for your retirement? And again, financial shortfall. 48% expect significant savings gap. Now, this is the research from the MD Financial, and figures don't lie, right? These are the statistics. This is what they've been able to, find out from the life of so many medical professionals. They've been, trying to, delve into and look into their finances. These are the things that they find out. So my question to you today, as a medical professional, do you want also to become another statistics? You don't need to wait on to become another statistics. You need to start planning. And that is why we have put this together for you as a medical professionals and business owner, that it is very important for you to start planning for retirement early, because we take it for chances, we take it for granted. We feel that, oh, I'm making so much money, and as such, when I'm ready, I'm going to start that. Some will tell you, I'm going to start next year, right? As you grow, as you continue in your career, it costs you more. Again, delay planning. 52% starts retirement planning too late, and that is why they work more. Some of them don't retire at 65, some retire at 70 because they retire late. Why? Because they didn't start their retirement planning early in life. So it is very, very important at this moment that we, as advisor, insurance advisor, we need to come up with this kind of presentations to show them, to open their, some really want to do it, but they don't have the right information, right? Some actually do it, but they don't have the right advice to start their retirement planning in life. So it is very, very important. Now, let's look at the business owner right now. Everybody, right? Business owner. Business owners. So business owners face additional risks. Number one, fluctuating business cycles affect retirement planning. We are in a world of uncertain things. Everything right now, things, life is not a bed of roses. Sometimes you have good months, sometimes you have good years, sometimes you don't have good years. So I take myself as an example. So the kind of business that I do, sometimes we have very good months, sometimes we have bad months, sometimes we have winters, we have summertime. So the income is not regular, and as such, it is my duty to make sure that when months that are not really okay, I need to save in order to cover up for the months that are, of course, fine. So you, as a business owner, this is additional risk. You have fluctuating business cycles affect your retirement savings, right? Sometimes you make so much money in a certain month, sometimes you don't make so much money. Number two, no employer plans must create their own retirement structure, right? So because you are not an employee, right? You work for yourself. So you have to plan for your future. You have to plan for your retirement, right? You must create your own retirement, strategies yourself. Again, business exit strategies. Sale may fund retirement, but require planning. So there are specialists that involved in business valuations and selling. So you need to know, how much is the worth of my business if I retired? If I want to put it into sales, how much will that be? Let's say in 20 years from now, 30 years from now, 15 years from now. You need to know, so that if you are using that as a way to retire, if there's going to be shortfall, you need to know, how do I cover for this shortfall? It is very important. Again, self-funded must build personal and business retirement assets. So you don't want to put your egg in one basket. You need to diversify your portfolio, right? You need to invest in real estate, bonds, shares, pension, life insurance. So you must have different vehicle, different portfolio for retirement planning. The reason is because if one does not do well, another one will do well. So you must spread your basket. Everybody's right. Retirement diversification. Retirement diversification. It is very, very key, right? You must diversify your retirement. You don't want to put yourself in your egg in one basket, because this is what happened. Now, if in Canada here, in the last like 2-3 years ago, right? About 2 years ago now, the housing market, experienced a serious crash. Why? Because government of Canada increased interest rate. Now, if you are a business owners or medical professionals and you rely heavily on real estate for retirement, and you retired during that period, and you're looking at your real estate asset as an investment vehicle, what do you think will happen to you? So that is why portfolio diversification is very, very key. You must look at your risk tolerance and examine which of these asset portfolio will I actually put my money. And you must work with experienced, professionals to guide you on what you need to do. Again, as a medical professional and a business owner, don't put your investment on something you don't understand. You must at least have a little knowledge of what you are going into, so that you understand both the risk and the opportunity there, and you'll be able to plan ahead, right? These are the mistakes some of the medical professionals, they don't have understanding of what they are putting their money in, and at the end of the day, they lose money. So you need to work with an experienced professionals to help you to guide this, right? Top challenges in retirement planning. Top challenges in retirement planning. Number one, inflation erode purchasing power. Everybody write purchasing power. In the comment section, please write purchasing power. Inflation erode purchasing power. The purchasing power is ability to have, to meet your demands, like to meet your obligations as at when due. Now, you agree with me that the rate at which inflation is on the side, especially in our country today, is crazy. My wife used to go to grocery, and we look at how much we used to buy grocery as opposed to 2, 3, 4 years ago. So think about it, right? Your $1 today will not be your $1 tomorrow. So you must understand the time value of money. So the earlier you put this money to work, the better for you. And don't delay, because as you are delaying, if you put that money somewhere, inflation is actually eroding the value of that money. So you must understand, how can I make my money work hard for me? 2, market volatility. Unpredictable returns threaten retirement planning. If you are putting your money in stock market, right, volatility is one of the very features of stock market, right? The market can behave in a different way. So if you are a medical professional and you don't take advantage of time, right, because based on historical performance, some stocks are doing very well in the long time. So if you don't put your money into work, you don't invest early, and you don't take advantage of time, you don't take advantage of the dollar cost averaging, you will be losing out. So all these, the dollar cost averaging will actually help you to mitigate the risk of volatilities when you are planning for retirement. Everybody write volatility. Volatility is one of the important features of stock market. If you are doing investment, you should understand that sometimes The market will go up, sometimes it will come down. But because you don't want to time the market yourself, right? You put this money to work and you give and you allow dollar cost averagings to do the work for you. When the market is down, all right, you buy more. When the market is up, you buy less. So this is how you can actually help, build your retirement, income. Tax track, diminished investment growth can claim up to 30 to 40, 50% of your return. So think about it. If you put your money in, so for example, if you are buying stocks, if you are buying bonds and other, investment, right? You should be ready to pay what you call, capital gains, right? Whatever you make on those investment, on those assets, you're going to pay capital gains. So now, at retirement, right, you might be like, you might be prone to pay a lot of taxes, especially if you have your money on investment that is 100% taxable on the gains. So you also need to know which of these strategies will I pay tax, what percentage of tax will I pay, so that you plan ahead of your retirement. It is very important to understand different investment vehicles and the tax implication so that you plan ahead of that. Healthcare costs escalate in later years, long-term cares, it's roughly about $6,000. Now, as you age, right, your health care, escalate, right? Think about the people that are in the retirement home right now, people that are of age, right? Whether we like it or not, at some point we are going to get to that level as well. So as you age, the healthcare costs escalate because you need more care, long-term care, health cares and all of that. You must plan for all of this. Otherwise, you just realize that you retired and you don't have a conducive environment for retirement. And I've seen a lot of that in this country where people retired and they don't really plan. They don't plan. You know that it's either they plan, it is not sufficient, or they don't have any form of plan at all. Some actually rely on government pensions or government benefit for their own retirement, and unfortunately, it can't take them anywhere. So, retirement planning is an important topic that we must not, just take with levity hand. We have to be very, very intentional about our retirement if you don't want to live a life of regret, especially for those of us who are parents, right? If you have children, once all of them go to university, they graduated, or they have their own families, you're on your own. You have to take care of yourself, right? So if you don't want to become a burden for yourself and to other family members, take care of your retirement. It's very key. And it's not difficult because a lot of us we take chances, we don't want to take actions, we delay things, we don't want to take risk. Well, if you don't want to take risk, well, you just be there, right? It's better to take a calculated risk than not to do it at all and start living a life of regret when you retire. Now, let's look at the cost of delaying retirement planning. Now, everybody typed cost of delaying retirement. Cost of delaying retirement. Number one, if you start at age 30, let's say, for example, you are putting $500 monthly into work. At retirement, right, you probably have about $1.2 million at your retirement. Look at this. At age 30, right? If you start at age 30, right, and you are setting $500 aside towards your retirement, you probably have about $1.2 million at retirement. And let me give you this formula. If you are working as a medical professional, at no point you must set aside 10% of your income aside towards your retirement. I mean, you are the one working. You are the one working. So once you get your pay, once you make that money at the end of the month, 10% set it aside towards your retirement. Now, what is 10%? It's not based on your philosophy. Whatever you are making in a month, Look at the 10% of it, set it aside for your retirement. Okay, because you are the one working, so you should be paid first before you pay anything, before you pay your bills, before you pay your car loan, before you pay your mortgage. Pay yourself first. Save that towards your retirement, right? And again, make sure you diversified, right? Different portfolio, different asset in real estate, bonds, shares, life insurance, cashback. You must diversify it. Now, if you delay it till age 45, right, it will cost you times 3 of what you're supposed to do at age 30. Look at it. That means you're going to be putting $1,500 monthly. That will give you about $1.2 million at retirement, times 3 of what you're supposed to put in at age 30. Look at the cost of delaying. And this is something that I don't understand. A lot of us delay retirement and we feel that, oh, it's normal. It's not normal, right? If you are from Africa and you are practicing in Canada today as a medical professional, right? So on average, is you're probably between the people that I've been seeing, like I've been meeting, is roughly between age 40 to 45, 50. So it is very key that immediately you start working, you need to start planning for your retirement immediately. Everybody type immediately. Immediately, you must start planning for your retirement. Look at what is going to happen to you. Mixed opportunity, lost TFSA room, lost unused RSP deduction, right? And underutilized corporate earnings. Now, let me talk about the TFSA. So in your CRA, okay, we all have room, right? Every year they will update it. This is your TFSA room, okay? If you don't start your retirement early, you are losing out from this. And tax-free savings account is another powerful strategy for retirement planning. Okay, so if you don't use it, it's a missed opportunity for you. Now, unused registered retirement, same for registered retirement, same plan, right? Of course, the money you put there is tax deductible, but when you start withdrawing the money, you start paying the tax. At least you enjoy the money right now. You enjoy your money. You don't pay the tax now. So take advantage of that. Don't delay your retirement. Of course, and again, underutilized corporate earnings. So, for example, is the retained earnings, right? Retained earnings after expenses, after tax on your corporation, the profit after tax is what we call retained earning. Now, if you don't start early, you might not be able to utilize your retained earning as well to build retirement next egg for yourself. So, guys, I'm telling you today, right? If you need a personalized advice, right, you can see your financial advisor or you contact me. At no cost, I'm going to walk you through on different strategies in which you can use to plan for your retirement. Don't delay it. Now, let's look at the strategic planning tools. Like, let's look at the strategic planning tools. Everybody type strategic planning tools. Strategic planning tools. Number 1, personal tax advantage account, which is registered retirement saving plan. So I'm going to explain there are 2-3 ways in which we're talking 3 ways for tax planning. No, 3 ways for tax planning. Number 1, pay tax now. Okay, we have pay later, and we have don't pay at all. So, and I will break it down using these strategy tools. Number 1, pay now is like bonds, stocks, mutual funds, real estate, anything that has to do with, like, if you put your money in any investment and you sell, right? For example, if you buy bonds or you buy share stocks, right? You put 10,000 in stocks and you make a gain of $5,000, $10,000. Bear in mind that you're going to pay tax on that interest, like the gains you make on it. We call it capital gain tax, interest. The interest you make on that, you're going to pay tax now. So that is what we call pay now. Pay now, right? Pay later is RRSP. Example is registered retirement saving plan, right? So now whatever you do right now, whatever you put there now is tax deductible. You're not going to pay the tax right now. But when you get to start withdrawing money from that registered retirement savings plan, you start paying for the taxes. And as a medical professional, you need to understand what is pay now, what is pay later, what is don't pay at all. A lot of people don't understand all these strategies, right? So I'm going to break it down again. Pay now, right? If you put your money on stocks, real estate, bond, shares, all right, whatever gains you make, you pay tax immediately. You pay the tax on the gains after the adjusted cost basis. Now, again, pay later is registered retirement savings plan. Example of that is registered retirement savings plan. You don't pay the tax right now, defer it to the later date. Like anytime you want to withdraw the money from the RSP, you pay tax. Don't not pay at all is tax-free vehicle like life insurance, cash value. Okay, you don't pay tax on it. And a lot of people don't really understand the power of life insurance, especially the cash value life insurance, right? We're going to use that, and I'm going to break it down here now to show you how you can leverage on these powerful tools for retirement planning. So if you put your money on RSP, it's a tax deferred growth, right? Whatever you put there, it's growth tax deferred, and when you start withdrawing the money, you start paying the tax. It's a powerful strategy for you as a medical professional to start planning for retirement, right? Number two, tax-free savings account. It is tax-free growth and tax-free withdrawal. So you need to combine all different portfolios, all different asset classes to plan for your retirement, right? So TFSA means that whatever you put there, right, it's growth tax-free, and you withdraw your money tax-free. And a lot of people don't know why it is actually growth tax-free, because you are saving after tax dollars into TFSA. So the money you put in your TFSA has already been taxed. So the only thing you enjoy there is you don't pay tax on the growth. So you need to understand this in order for you to leverage on different strategies, vehicles to plan for retirement, right? Everybody type RSP TFSA as a strategic personal tax advantage. Number two, corporate strategies. Corporate strategy like individual pension plan. So as a medical professionals, you have opportunity to do like two things when you are, when you're working, right? You can either take dividend and you can take salary, but some people do both, right? You can take dividend, you can also do salary. So if you are doing salary, right, at the end of the month, your accountant prepare your T4s, and they remit, they prepare your payroll, and whatever deductions, whatever it comes as a tax, they remit to CRA, and they also remit your pension there. It is very important that you explore all different angles for your retirement planning. I'm saying this so that you don't put your egg in one basket. I've seen a lot of people, right? All the investment they put their money in didn't do well when they retired. And the only thing they can actually fall back on is their pension. So please do pension as well, right? Do a little bit of dividend, do a little bit of salary. Make sure your accountant look at your financial report and look at what is really good for you in considering your risk tolerance, okay? And corporate investment account, like you can also set up corporate investment account on your corporations. It's another way of planning towards your retirement. The third one is insurance-based solutions, which is cash value life insurance, right? The cash value life insurance of different. So we have the whole life insurance, we have universal life insurance, and we have term insurance. It all depends on your needs. It all depends on your budget and what you are looking to achieve at the end of the day, your retirement goal. So based on that, we're going to set it up for you, okay? And again, that's what we call, so you can actually use Insure Retirement Program. It's a very powerful, you can Google that. If you Google the internet right now, you're going to see that these are what the high net worth individual use, what they use for their retirement. So you want to leverage on all of this for your retirement. So you don't want to focus on one area for your retirement. Now, let's look at the case study of a medical professional in North. Let's say this is Dr. A. Dr. A annual income is about $250,000. Okay, $300,000 of annual income, and he puts $250,000 in registered retirement savings plan at age 45. Now, the retirement goal is to have $120,000 annually starting at age 65. So there is an projected gap of about $1.2 million shortfall. Now, required action is that you actually set up $35,000 annually saving strategic tax planning into a vehicle that will provide tax-free vehicle of about $1.2 million from when he retired. So this might not be your own case. Like I said, it is just an hypothetical example. So if you want to know if you want to really understand your financial needs, or you want to know how much do I really need regarding my retirement, please book a personalized call at no cost. I'm going to walk you through on what you need to do. Right now, let's look at the planning tips for medical professionals. Number one, medical professionals corporation, you need to set up a tax advantage structure for income and investment. Now, there are so many, I've explained that in the previous slide, that there are so many tax advantage accounts that you can set up in order for you to start, for your retirement. Also, you also need to look at income splitting. Income splitting is distributing, balancing your income between you and your spouse or your common law. Everybody write income splitting. So you distribute your income to family members strategically. So it's a powerful way for tax planning and retirement planning as well. So if you want to learn more about this, right, I'm here. I can guide, I can show you more. Because of the time, I may not be able to go into the details. Of course, we also look at the retained earning, optimize corporate investment for tax efficiency. Now, let me quickly explain what retained earning means again. Now, a lot of people don't really understand what retained earnings means. Retained earnings is, as a medical professional, let's say, for example, you make $500,000 in a year. Less expenses, less maybe salary, less gas, whatever expenses that you have, right? You less that, right? So the remaining balance, let's say, for example, you make $500,000 in a year, your expenses in a year is roughly about maybe $300,000. So you have a profit before tax of, let's say, $300,000, right? So when they apply tax of about 12 to 13%, depending on your tax bracket, so the remaining balance, the remaining amount, all right, that is what we call retained earning. Okay, so it's a very powerful tools for retirement planning. Right? How do you do that? I will show you what you need to do about your retained earning. It's an important areas that medical professionals need to be properly educated on. How do they invest? How can I invest my retained earning? Because if you invest your retained earnings, right, once we make profit more than $50,000, you break the small business rule, so you're going to be paying about 50% on taxes, and you don't want to do that. So these are the things, these are the strategies for you to build powerful retirement planning for yourself. Again, liability protection, shield retirement assets from professional liability. So a lot of times we really don't understand that all these assets need to be protected from professional liability, right? If you have your asset, the corporation asset, right, it needs to be properly protected. Okay, using life insurance and other strategies to make sure that in case anything happen, right, your assets are properly shielded. Because think about it, if your corporation is part of the strategies to use for retirement planning and you don't protect it, it means that you expose yourself in retirement. Now, planning tips for business owners. So let's look at the planning tips for business owners. Number one, plan share sales versus asset sales early. Now, if you are looking to use your corporation as part of your retirement planning, you must do this. Number one, you must do a proper valuation of the asset prior to your retirement. How much is my corporation, okay, at winding up, right? Is there any tax due? Is there any liability? If you are owing CRA, all these things must be accounted for before you start planning for retirement. All these things is very, very important, because many people plan for their retirement, They don't really look at what is the worth of my corporation and what is the value of my corporation if I retired. All right. So if you also want to, if you have assets that you want to sell, let's say you have real estate, you have bonds, you have shares, right? Do you have enough money to cater for the tax? Now, if you are doing real estate, you know that you're going to pay capital gain tax. Do you have enough money? Because as you are planning for retirement and you have so much estate, you have so much asset, right? It makes sense for you to also plan for the tax that will accrue, especially when you dispose those assets, right? You must plan for that. And it is not something that you can just start talking about. You need to sit down with your accountant, with your advisors. Can you provide me the breakdown? Give us the schedule of the asset, the motor vehicle, your building, all the asset, everything that is in the corporation. If it's part of your retirement strategies, you need to start doing estate as it's right now, as a strategy. Okay. 2, corporate structure. Use holding company and trust effectively. This is uh, a very powerful strategy for you as a medical professional and businessman. Let me tell you this. If you don't know, if you don't manage your retained earnings very well, right, you might be shooting yourself at the leg, right? You might be losing out on your retirement, right? And one of the way to do that is to use your holding company, right? And create a trust in such a way that even if anything happens, your money flow to your beneficiary tax-free. And this is you see, as a business owner, right? You must also begin to think of estate planning as well, right? Because as you want to retire, your children as well is there. If you want to leave legacy for them, is it properly protected? Because you don't want to go, right, and you don't have enough plan in place. What about will? Do you have will? Because if you don't put all those things down, it means that you are telling government of Canada to start distributing your asset. If you are not in Canada again as well, anywhere you are, you must, once you have at least one house, right, you must have a will and a trust so that you don't put all your assets in the hands of the government, because you are telling them that, oh, government, they will be the one to distribute your assets when you have the opportunity to do that. So if you haven't done that, right, please go and do that. I understand most of us, because you are from for example, me as well, like I don't want to listen to things like that. Okay, are you saying that I'm going to die tomorrow? No, it's not because you want to die tomorrow, but because I don't want government to come and distribute my asset. That's what I need to do as proper estate planning. Business valuation. Incorporate expected save values into retirement plan. Now, know the exact amount that is going into your corporation. How much is the corporation? Okay, $2 million, $1 million, $500,000. At least you know the amount. Look for professional valuers to value your corporation for, and you must have a succession plan. Develop internal or external transition strategies. If you don't have this, and this is one of the things that we lack as an Africa, we have a very good business model, we have a very good business, but we don't have a succession plan, right? Majority of these businesses, once the owner pass, that's the end of the business. It shouldn't be like that. There must be exit plan. There must be succession plan. What is going to happen after once I retire? Who is going to take over this business? Do you have people? Do you have key person in place that will soon going to take it over? Right? If you have people that you have been training, do they really understand the models? How do you run the business? Even if they're medical professionals, are they specialists in your field? Because we have different specialists, right? If they are not a gynecologist, or maybe they are not family physicians, or they are not surgeon, right? You need to know who is going to, take over this practice from me if I don't want to sell it, right? Do I have something that is going to be coming to me in form of retirement income? Is very, very key. You need to plan for that. Right. Your next step is this: consult an advisor, schedule a meeting to address your retirement needs. So let schedule a meeting with advisor. Let them run a detailed financial analysis, understand your asset, your liability, the income gap, right? Let us help you to look into your lifestyles and project how much do I need every year if I retire today, right? And see, you don't delay retirement. Everybody type, you don't delay retirement. You don't. So you need to be very, very intentional about your retirement. Two, assess your finances. Everybody write, assess your finances. Assess your finances. Assess your finance. Evaluate your current financial position. See, if you don't understand your current financial position, it's very difficult for you to project for the future. So you want to assess your current financial positions to know where I am right now. Where am I going to? That will give you at least understanding of what you need to do. 3, explore tax strategies. Identify tax efficient retirement planning options. So as you are looking towards your retirement, right, your goal is how can I save taxes as much as I can, right? You don't want to retire and you realize that all the money you save, majority of it has gone to taxes. Think about it. You are paying taxes on grocery, paying on gases, everything is taxes. I'm not against people paying taxes, but if there is efficient way, right, to plan to reduce that tax liability, please explore it. Explore it. Is very, very important. Now, my final thought. Retirement won't happen by accident, right? Everybody type, retirement won't happen by accident. Retirement won't happen by accident. Won't happen by accident. Retirement won't happen by accident, right? We must plan for that. We must plan for retirement. 2, it must be designed intentionally. I've not seen anybody that's enjoying his retirement today that does not plan intentionally. You must plan intentionally. Okay, put strategic, actionable steps in place for you to plan for retirement. You deserve to retire on your own terms. I was speaking to a medical professional like a few weeks ago, and I said, look, if you really want to retire, say 10 years from now, we can put that strategies in place today, and you are going to achieve that, right? It is not how much you make. It is not how much you make. See, people that build wealth, right? They are not making so much money, right? It is because they have one habit, right? Consistency. If you want to retire at your own terms, you must be very intentional, and you must really, really desire, like you must put your mind into, I need to do this. Can you put 10% of your income aside towards your retirement? Many people don't want to do that, right? Many people don't want to do that. So if you're not ready to do that, well, it's very difficult for you to retire. And again, let's build a plan together. Everybody type, let's build a plan together. Let's build a plan together. So you have to work with professional, experienced advisors that will help you to structure a proper plan for you to retire at your own terms. So thank you so much for listening. So I just want to use this as a call to action, right? Many of us have been going to webinars, seminars, events like this. You attend. Did you take action? Did you take action? So you need to understand that at as much as you can, right? You need to take action. If you don't take actions, it means that you just come here today and listen to it. Like I said, share this with medical professionals, share this with business owners, so in order for them, to understand what do they need to do. Like, I'm sharing this information for free. I'm not saying they should contact me, but at least they know that they have different options for them to retire. And again, they must plan ahead to retire at their own time. So if you need any form of personalized services, you want a free coach, you want to discuss another thing, I specialize so many areas, but I focus mainly, I do other things as well, but at least I focus mainly right now on medical professionals. But if you need any other like coaching, mentorship, you can just scan the QR code and book a personal call with me, and I'll be more than happy, to help you. Once again, thank you so much. I'm going to stop sharing. If you have any question, I want us to quickly look into that. Any question, please? Any question? If you have any question, please type it on the chat box. Okay? Any question? Any question, please? Any question? All right. Once again, I want to thank everyone for joining this event tonight. So we are hosting this event twice in a week. On Friday, we have a special training for insurance agents that are struggling to scale. And on Saturday like this, it's designed for medical professionals. So for those who actually want to specialize in high ticket kind like business professionals, you can as well join us so that you can learn on what you need to do. I'll be sharing some information, especially on IFA, retirement planning, retained earnings, uh, um, different strategies for retirement planning. I'll be sharing information on that. So if you have friends, colleagues who are looking to plan towards their retirement, it's very key. Share this with them. Again, like I said, share this with friends who is looking towards retirement. Share this with anybody that you feel that you really need guide. And it's not only medical professionals and business alone. Everybody needs to retire at their own times. Everybody needs to retire well in their own at their own time. So if you have anybody who is looking towards retirement planning and is struggling, he doesn't even know how, he's confused, he doesn't know where to start from, right? Please let's share this with them. Okay, how do you think we can reach out to more people to be more informed? Thank you, Tosin. Oluwatosin. Well, I did a presentation yesterday on how to become an authority in your niche, right? It takes time, Tosin. It takes time. You have to build credibility, right? And part of this is this one, right? So make sure you share valuable content every time. Trust me, when you share information like this and people see value, they will reach out to you. I've seen professionals reach out to me. Let me give you example, my experience with one professional, right? I met him last year. We set up a very powerful strategist for retirement planning for him. And when he wanted to buy his first house, he just reached out to me and said, Mr. Fashola, I want to buy a house and I need your advice, right? And he said, I have about over $150,000 and I want to put. So we're actually looking into putting up IFA strategy for him. So, but the problem is that his corporation is just less than a year, so we can't do that. But it's really ready for IFA. It's ready to do it. What am I trying to say? When you serve, when you add values to clients' life, they will come back. They will come back 100%. So, Tosin, add more value to yourself, right? Be visible every time. Okay. Go out there and dish out information with the mind of educating them, right? One of my mentors would tell me, I don't care whether you buy or you don't buy. All I want to do is to share that information. Once I share, right, you will reach out and say, look, I need your service. Okay. So I think that's all. Oh, uh, this is one of my very powerful colleague, Ajiri. Thank you so much, Ajiri Alibo. It's very very. I'm so excited to have you here today. These are the people that really inspire me to, when I started my entrepreneurship journey. I bless the day I met you, and I want to say thank you so much for joining tonight to connect after this meeting. Once again, everyone, thank you so much for joining tonight. See you next week, the same time, to share another important information. See you. Bye.